So this is a quick primer on how to find and accept money from investors. Let's have some quick introductions. First, I've been writing, producing, and publishing profitably for more than 20 years, and I've taught for UCLA, the Art Institute, and Autodesk, among others. I was a lead curriculum developer and senior business mentor for an entrepreneur training program in the UK for 7 years. I built and managed a team of 8 lawyers, MBAs, etc. I've trained and mentored hundreds of writers, producers, entrepreneurs, co-founders at every stage of development. I developed this curricula after reviewing the American Bar Association curricula on Regulation D Private Placements and contacting the California state attorneys who regulate Regulation D Private Placements. It's been read by multiple attorneys who agree it's a solid overview of private placement rules and requirements. Having said that, I'm not an attorney, and this is not legal advice. You must work with an attorney or certified financial professional before creating your private placement or offering it to investors. There are state and federal rules you must obey and tax implications you must consider that will be specific to your situation. Furthermore, these details change over time. Legal, financial, and tax advisors keep up to date with these changes, which is another reason that you need to work with them. The next thing we sort of need to cover is that most entrepreneurs raise money from investors through private placements. It's the most common way to raise money from investors. There are other structures that people can use, like convertible debt, but in order to use those methods, you still need to understand Regulation D private placements. Now, the process of raising money through Regulation D private placement is not impossibly hard. It's not expensive, particularly compared to other funding options, and it's commonly used because it is fast and cheap. If you don't follow the rules, however, your mistakes will be extremely expensive. Regulation D private placements are how most startups and small businesses accept money from investors, whether they're raising money for a film production company, a high-tech startup, dry cleaners, doesn't matter. The term equity in this context means ownership. People who invest money in your startup through a Regulation D private placement are purchasing shares that give them ownership of your business. If you issue 100 shares and sell 2 of them to someone, that person owns 2% of the company. Generally speaking, whoever owns the most shares in a company controls the business. If you're running an LLC, you're not selling shares, you're selling percentages. Now, people who purchase shares have many ways to earn money. Shareholders can sell their shares for more than they purchased them for. This is common when a high-tech company sells itself to a bigger company. The shares of the small company owned by its initial investors become more valuable. Shareholders can get their initial investment back plus a small guaranteed profit per share and then get paid a percentage of the profits earned by the business after that. One of the reasons you need to work with attorneys and financial advisors is to come up with investor compensation strategies that are favorable and familiar to investors. So, in 1933, in order to reduce the number of investors getting conned out of their money by unscrupulous people offering investments, the federal government stated that any offer to sell securities or shares must be registered with the SEC or must meet certain qualifications that exempted it from such regulation. Regulation D of the United States Securities Act of 1933 outlines the exemptions from SEC regulation. There are 3 exemptions: Rule 504, Rule 505, and Rule 506. Now, which regulation you decide to use to raise money from investors impacts how much money you can raise. You may be surprised to learn that raising more money often requires less work. In 1933, many of the most important rules and regulations concerned general solicitation, which is to say approaching strangers to offer them investments. Those raising money were required to have a previous relationship with those they sold shares to. In 2013 and 2015, some of these rules were relaxed in very specific ways, which are briefly described in this document. And I want to just give a quick overview for why Regulation D exemptions were created. In 1933, when they set up these new rules and the Securities and Exchange Commission, people said, listen, it can't be the case that I and my neighbors, in order to build a new granary or in order to acquire equipment so we can farm our farms, have to go all the way to Washington in order to be able to raise money for things. So the Regulation D exemptions were set up initially so, in effect, neighbors and people who already knew each other could get together, raise a bunch of money, set up a little business in order to do something that needed to be done locally. And the reason that the exemption exists is because it was supposed to be people that knew each other already. So you already knew the character of the people that you were investing money in. If you look at the rules that govern Regulation D private placements, you'll hear them talk about a blank check company. And a blank check company is a development stage company that doesn't really have a specific business plan or purpose, or who has indicated that their plan is merely to engage in a merger or acquisition of an unidentified company or companies, and thus to become more profitable. When we talk about the Regulation D private placements, you'll also hear the term Form D. Form D is an online form you can find on the SEC website that outlines the nature of your offering, the exemption that you're claiming, and it collects your contact information. And the reason that there is a Form D is that if people complain later, if investors put money into your project and then later decide that there's been any kind of fraud or malfeasance, the SEC wants to know where to find you. So that's why you register a Form D before you start raising money and after you've completed raising the amount of money that you need for your business. Form 25102 is a form that you file with the state of California, which provides them with similar information to a Form D. General solicitation is approaching complete strangers to offer them an opportunity to invest money in your business. Before you start approaching people with your investment, you really do need to work with an attorney to find out how it's legal to approach them and learn what you're allowed to say to them and promise them and what you're not, because there are rules that govern what you say and who you approach. Now, in 2013, the SEC made it legal to post your investment on portals where accredited investors could see it and invest in it. In 2015, it became legal, if your investment opportunity obeys quite a number of rules, to sell investments to unaccredited investors. These portals are called equity crowdfunding platforms, and there's a whole bunch of them. There's one for the film industry called slated.com, and there's others like Crowdfunder, Fundable. Accredited investors can actually go to these platforms and look at a whole bunch of different opportunities to invest their money. Disclosure documents outline, without any sales pitch or persuasive language, the risk people are taking when they purchase shares or purchase ownership in your business. And there are rules for what must be covered in disclosure documents. One of the most important terms you need to know if you're going to be accepting money from investors is the term accredited investor. Accredited investors are people who meet a certain set of criteria which the SEC has decided makes them capable of judging risks and opportunities. There are a bunch of accredited investor types. A person with a net worth of over $1 million, a person who has earned $200,000 in each of the last 2 years or $300,000 for a couple, a corporation with a net worth of over $5 million, a trust with a net worth of over $5 million. And in the set of slides, you'll see there's a link to a government website that lists all the different kinds of accredited investors. There's a term that's very similar to accredited investor, which is sophisticated investor. It's a term relevant to investments made here in California, and it means an investor who is either personally or with the help of an independent investment advisor able to make intelligent decisions about whether or not to invest in an offering. A non-accredited investor is a person who doesn't meet the SEC's minimum requirements, and this is usually a person known to the business owner as a family member or friend, etc. They, like accredited investors, need to see all the same disclosure documents in order that they can make the best possible decision based upon what they know of the business and the character of the person that owns the business. And the reason I mention that is sometimes people think, well, if my dad's investing in my business, I don't have to show him the same stuff that I show everybody else. The truth is that you do. They, like accredited investors, can sue if they are defrauded. Rule 504 lets you sell up to $1 million worth of shares in any 12-month period. You can't be a blank check company. There's no ceiling on the number of investors you can have. There's no restrictions on the number of offering. There's no specific rules and disclosure documents you must give investors, though you do have to make full disclosure to them. There's no restriction on the resale of those shares after they're purchased. In California, the state requires you to file a Form 25102 before you approach investors. The SEC requires you to file a Form D before you approach investors. Now, why doesn't everybody use Rule 504? The reason is because really you're sort of taking the same amount of risk that you'd be taking for raising a larger quantity of money, and you still have to create disclosure documents. So there's kind of no reason not to just go ahead and go with a larger offering. The only person I've ever known or ever read about that really did a Rule 504, and I'm sure there's others, but it's the one that I read the most about, that I could find the most information about, was a company that ran a publication And the guy that ran the publication needed investment in order to be able to expand this publication, which targeted a very small market. So he basically raised money by reaching out to his subscribers who gave him investments. And he raised under $1 million using the Rule 504. You know, he was very successful. And in a sense, it was before the era of Kickstarter, you know, Indiegogo, and, you know, kind of served basically the same purpose. He had people who were already supporting him, and he needed more money in order to expand. And so they gave him that money under the Rule 504 private placement. Rule 505 lets you sell up to $5 million worth of shares in any 12-month period. You can't be a blank check company. You can sell shares up to 35 non-accredited investors and an unlimited number of accredited investors. There are specific rules on how you approach investors. In California, you can know the investors previously, reach them through third parties that know both of you, like financial advisors, or reach them through portals like slated.com, equitynet.com, crowdfunder.com, fundable.com. There are specific disclosure requirements you must meet in order to ensure that all investors receive all the information they need in order to understand the risk they are taking. In California, using Rule 505 means you have to file a Form 25102, and the SEC requires you to file a Form D. Rule 506 allows you to sell an unlimited dollar amount of shares in any 12-month period. Your company can't be a blank check company. You can sell shares up to 35 non-accredited investors and an unlimited number of accredited investors. There are specific rules on how you can approach investors. In California, you can know the investors previously, reach them through third parties that know them, like financial advisors, or reach them through portals like slated.com, equitynet.com, fundable.com, crowdfunder.com, etc. There are specific disclosure requirements you must meet to ensure that all investors receive all the information they need to understand the risk they are taking. In California, the state does not require you to file Form 25102, which it does require you to file if you're doing Rule 504 or Rule 505 investments. The SEC does require you to file a Form D. So most people who accept money from investors use the Rule 506 Regulation D exemption. There are 4 documents you must share with investors before you accept their money: a private placement memorandum called a PPM, a subscription agreement, an investor questionnaire, and purchaser representative questionnaire. So a private placement memorandum is simply a document that discloses all the risks of investment in the company in exhaustive detail. The business plan and financial forecasts are usually an appendix to the private placement memorandum. It must be very factual. It's not a sales pitch. In fact, actually, it's an anti-sales pitch. Usually it says you can lose all of your money. There's a million ways that you can lose your money. It's not safe to invest. You know, investing is taking a risk. It's very important that you know that you're taking a risk. So the business plan, and which is attached to the private placement memorandum, outlines what you plan to do. The private placement memorandum outlines the risks that the people are taking and reviews the fact that you may change your business plan based upon market conditions. If you leave material information out of your private placement memorandum, you open up the possibility of investor lawsuits. So for example, if you use the investment money to pay distributions to other investors, so that means if you take in $1 million, you have 10 existing investors, so just so you know what a Ponzi scheme is. A Ponzi scheme is if I take if I have 10 investors already in my company and I get $1 million, and I take that $1 million and I pay each of the existing investors $100,000, right? And it makes it look, they might think, wow, your company's being really successful because you're paying me these dividends. But really what I'm doing is I'm just taking one investor's money and giving it to other investors. That's a Ponzi scheme. It's illegal. So if you're planning to do that and you don't mention it in your private placement memorandum or your business plan, that's a problem. In fact, even if you do mention it in your private placement memorandum or your business plan, you're in trouble. But it's an example of something you would have to mention. It's the example of the kind of thing that you would have to mention if you were planning to do, because it would be illegal. Serious illness of a key person. So if you've had cancer in the past, or or you've had serious mental illness in the past, it's something you have to disclose in your private placement memorandum. Previous SEC sanctions. If you've gotten in trouble with the SEC before, that's something you would have to mention in your private placement memorandum. Material litigation regarding the company or its assets. So, for example, if you're planning to produce a film, but you actually happen to have a slight lawsuit going on with the writer of the script, and he's saying, no, you can't use my script, that's something you would have to put in the private placement memorandum. So the private placement memorandum is supposed to disclose in full detail and gory detail all of the risks that people are facing. Subscription agreement is the document the investor signs to say they're purchasing your stock at agreed upon price. And in effect, it's a detailed summary of the PPM along with all the financial details of the transaction. Investor questionnaires are where the purchasers document that they are indeed accredited investors or not accredited, as the case may be, where they specify net worth, income, and other relevant data. If you purchase a private placement memorandum template, they'll have the subscription agreement investor questionnaire as part of the package as a general rule. So purchaser representative questionnaire is not generally needed when you're making your offering directly to accredited investors. It documents the relationship of a purchaser representative to the purchaser, like a financial advisor or tax advisor. The relationship of the purchaser representative to the company raising the money, like, let's say you and a little old lady from Pasadena both share the same tax advisor and he decides to connect you, then he would have to complete the purchaser representative questionnaire. It would also document prior investment experience of the purchaser representative. It would document the existence and terms of material or financial relationships between the purchaser representative and the issuer of the shares and any affiliates during the preceding 2 years. So, for example, if you and the little old lady from Pasadena that's going to invest in your film both share the same tax advisor and he decides to introduce you, it would have to document the fact that he was your tax advisor for however many years, and it would have to document if he was getting anything on the back end or any material reward for bringing you investors or any of that kind of thing. And it would also provide a disclosure to the purchaser of that material relationship. On September 23rd, 2013, the SEC changed the rules by which businesses may approach investors. They published a general fact sheet that outlined new rules, including the use of portals. In 2015, the SEC announced further changes to allow large numbers of non-accredited investors to invest money in companies. This process is nicknamed a mini IPO, and companies that use this method to raise money must meet a lot of requirements. So let's just sort of take a quick moment to review what this means. So in 1933, they set up rules by which people who knew each other could get together and invest in financial opportunities together. That was a Regulation D Private Placement. In September 23, 2013, the SEC made it so that you could post your investment opportunity on a portal, and accredited investors that you didn't know could log in, take a look at the opportunity, and decide to reach out to you and or invest in your offering. In 2015, they opened up the opportunity for large numbers of non-accredited investors to invest money in companies. And the reason that this is important is if you think about the fact that there once was a company called Google, and people who were accredited investors could purchase stock in Google. And many of those people who were those initial investors got very, very, very wealthy from making those investments. Well, in 2015, the SEC made it possible for non-accredited investors to take advantage of those kinds of opportunities. But in order for companies to reach out to non-accredited investors, they have to walk through a fairly sophisticated and an in-depth process of documenting their company, which is called a mini IPO. It's called a mini IPO because it is about as difficult as doing a small initial public offering. You have to do a lot of disclosure. You have to do a lot more to reach out to non-accredited investors than you do if you just want to do a standard Regulation D private placement. In the future, it's very likely to be the way most people raise money for films, or most people raise money for apps, or most people raise money for video games, because It allows the people who are your customers to decide to purchase stock in your company that funds the product or service that they want to buy. But at the moment, it's so new that it's still a bit of the platforms don't exist, and there's not a lot of people actually using this to fund their business yet. In the future, it'll be a big deal, but at the moment, it's not. Sometimes you'll hear this process called Title III. So when you hear Title III and mini IPO, both of those things are the same. It's taking money from large numbers of non-accredited investors. Generally speaking, if you're selling your investment to people through portals, only accredited investors should be allowed to buy shares. This will likely change as many IPO or Title III options are implemented. When you're raising money, you file a Form B with the SEC. Verifications must be done by companies asking for investment, and they're required to confirm that each accredited investor they accept does in fact meet the required standard. And there are penalties for not adequately meeting and following general solicitation requirements set by the SEC. So let's have a quick introduction to valuation. If you start your company with 100 shares and you sell some or all of them for $1,000 each, you just valued your company at $100,000. If someone else buys a share at $2,000, your company is worth $200,000. If you own any of those shares, presuming that you issued them to yourself when the company was first started, you've seen a $2,000 unrealized capital gain per share. That's true even if you can't sell all the shares for $2,000 each. So the reason you need to know this is that the alternative minimum tax makes people pay taxes on unrealized capital gains in some cases. That's one of the reasons why you must make sure that you seek professional financial advice before you set stock price, sell shares, etc. This is extremely important for those who will be giving employees stock options, restricted stock units, or vesting employees with stock over time. You can cause true, serious financial hardship and real financial damage to employees and others by giving them stock at the wrong time and under the wrong set of circumstances. Do not issue shares or decide percentages of ownership of your company without talking to lawyers and financial planners. Just because there are 3 founders in your company does not mean you want to give each partner 30% of the company. Doing this kind of thing can make your company unfundable, and it can tie ownership of the company's intellectual property in knots. If it's a film company, what does it cost to produce the film, market the film, distribute the film, etc.? You need to create rational forecasts and cash flows. You need to figure out how you're going to reward investors, like what return you're going to be offering them. You need to get audited financial documents from a CPA. This isn't always required, but sometimes it is. You need to create your business plan. You need to create your private placement memorandum with a subscription agreement, investor questionnaire, representative questionnaire. You need to go to attorneys and financial advisors with experience in helping people raise money through Regulation D Private Placement to create these documents, and the ones that you'll file with the state and as well as with the SEC. And make sure that you consider capital gains and tax issues for both you and your investors. I just mentioned in passing, a lot of times companies kind of crazily offer people stock options. And the problem is that if you give, let's say you have 10 employees and you give them all stock options, and then, let's say they have the option to execute those stock options over 4 years. So they get to 4 years in and, they scrape together the money they need to exercise the option and get their stock. Now that stock at the point that they're paying for it, maybe they're paying, 10 cents per share, or who knows, something ridiculous. But on paper, the stock may be worth $1 a share, because that may be what, when new investors put money in, that may be what you're charging per share. Well, the people that purchased those stock options, when they got the stock, they actually have to pay tax on 90 cents per share, right? And even though they're not selling their shares to someone else, even though they're not actually getting that income for the increased value of the shares, the government will make them pay tax on it. So you need to really understand that when you issue shares to people or stock options to people, that you're creating a tax implication to them. And the same is true for investors. So you have to work with attorneys and with financial advisors before you start passing out shares, before you start giving people stock options, before you start setting a price for your shares. You can't do any of that until you actually work with attorneys and financial advisors. If you do, you could be setting yourself up for real hassles. And even though you might think, wait, it's just a mistake. I messed up. The SEC and IRS take that stuff really seriously. So they're totally happy to punish you for those kinds of mistakes. So again, it's not hard. It's not difficult. You just need to make sure you're working with the right people to get the right advice on how to set the price for your stock, how to offer people the opportunity, how to reward people who are part of the project with shares without, without creating tax implications for them that they can't deal with. Once you've worked with the attorney and you've created a private placement memorandum and everything's legal and above board with your investment and you've worked out all the financial details in the business plan, you're going to reach out to investors. And to do that, you're usually going to create a pitch video, a pitch deck. You're going to go onto portals like slated.com, Fundable, Crowdfunder, EquityNet, and you're going to make the opportunity known to people. You're going to file the Form D with the SEC in the state of California. You're going to file it again when you've raised all the money that you need. And then you're going to make sure that you operate your business honestly and transparently going forward, which means if there's a problem, you're going to let investors know. When things are going well, you're going to let them know. Basically, you're going to keep your investors informed. There's a couple of things I wanted to say specifically to filmmakers. Raising money from investors requires building an accurate budget, shooting schedule, cash flow, marketing and distribution plan, a business plan, and understanding intellectual property fundamentals, like how to buy scripts and who owns what a DP shoots. If you're new to producing and marketing media, you may find the following links helpful: producer's task lists, creating budgets, breakdowns, and schedules, intellectual property fundamentals, etc. If you have any questions, you can email me at nancy.fulton@yahoo.com. The reason it's important for you to do all of this before you start looking for money is you don't know how much money you need until you do these financial documents and business planning exercises. So a lot of filmmakers decide to go out and get money far too soon, and they don't ask for enough, or in some rare cases, they ask for too much. And the result is that they end up with a project that really cannot succeed financially. So if you have any questions about the information I've covered, feel free to reach out to me at nancy.fulton@yahoo.com. I'm not a lawyer. I'm not a financial planner. I'm going to tell you probably to go talk to those people, but I'm always up for a quick 5-minute question.